Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I had him on about 6 months ago for the first time. He is a 5-time Dow and Founders Award winner. He has multiple exchange-traded funds that he created as an entrepreneur, the Risk On and Risk Off ETF, the Junk On and Junk Off ETF. He also is a mutual fund portfolio manager and publisher of the Lead and Lag Report. Michael Guyette, thank you for joining me again.
I can't believe it's been 6 months. It's like that. What's that saying? The days are long, but the years are short. I mean, the months are in between, I guess.
And the Fed has been hiking rates, although they just did take a pause. Maybe that was so the Treasury General account could be refilled at cheaper interest rates, but they're saying that they're going to hike rates twice more. Before we talk about the Fed, I want to get your views on the general. I want to get your general views on asset prices and the global economy.
So I guess it's a question of sort of what market, what asset prices. So this has been like a really bizarre year coming off of the horrendous action last year, right? Which was historic on so many levels in terms of the way stocks decline, the way bonds in particular, as you know, decline, the failure of the flight to safety trade. So you've got a very bifurcated type of environment. On the one hand, you've got the headline averages like the S&P, the Dow, less so the Dow, much more so the NASDAQ, what people would consider, in quotes, the market, looking like they're just ripping, everyone screaming melt up when they were nowhere to be found in October, when I first kind of brought up that idea. And against that, you've got the vast majority of other stocks which are badly lagging, underperforming, many of which on a after inflation basis are actually negative in 2023. And that, I think, really tells a story not just of how frustrating it is to trade and allocate, but also tells you a lot about the nature of the economy as well, both in the US and globally, in that we really are in a world where it's two different worlds within our world. You've got the tech plays, you've got the very wealthy rocketing, and you've got everything else struggling, everything else kind of not really keeping up with the strong economy narrative. And I think that becomes really scary in a lot of ways, in that the more that you don't have participation by lower middle class economically, the more you don't have participation by small caps, in the supposed new bull market, the wider the gap becomes between rich and poor, the wider the gap between corporation and individual becomes, and the more risk there is for a blowup. I've made this point before, given that the NASDAQ is up like it is, and it's largely driven by just 7 names, you're getting to a point where like these headline, in quotes, diversified stock market averages aren't diversified. Like there's actual idiosyncratic company-specific risk now in owning the S&P and owning the NASDAQ. Nobody cares about that for now, right? But that to me is like really scary, because that would suggest that we're at a point where people are taking so much more concentration risk than they realize against an environment where most of the things are just telling you it's not that great.
Is a lot of this because of the general nature of stock market index funds and how the majority of them at Vanguard and others are market cap weighted?
Yeah, so it's interesting. I know people say that market cap weighted is passive. It's not true. It's active in the sense that it's momentum based, right? Because the stocks that become larger, obviously get more inflows, and inherently that momentum continues from that perspective. But yes, I think there's some of that. Now, some people will say that, listen, this is the nature of markets. It's the Pareto principle, right? You'll always have a small number of things making up the vast majority of gains. That's true, but you've never had a period in history where the S&P 500, the top 5 stocks made up, 25% of the index. You never had a period in history where the NASDAQ 100's top 10 stocks made up 60% of the index. So, yes, there is an element of this just sort of being the natural order of things with a market cap weighted type of approach, but it's now getting to the point where it's almost debatable if you can be a fiduciary talking about diversification and then buy a Vanguard, in quotes, passive fund when that concentration gets larger and larger. Right. So this is, I think, actually a really remarkable moment in history, in that everyone really is. It's not just hyperbole. Everyone really is crowding into the same trade. And many people are not even realizing that, because they think they're in a diversified basket, which increasingly is not diversified.
Yeah, I'm just seeing the trolls below the post calling us perma bears. I'm not a perma bull or a perma bear. I'm trying to look for data and the stock market rally. I mean, my friend Aaron Basil, he was calling for a bear market rally months ago. So he was predicting a bear market rally, but now it's kind of getting ridiculous with the valuations. I mean, people aren't even looking at any of the fundamentals. They're just calling Nvidia going higher and higher. People are buying call options that know nothing about stocks and then trolling other people that missed this move.
Yeah, and listen, I mean, I have fun with like the Nvidia stuff on Twitter, right? I mean, I have no position I could give a shit about Nvidia, right? But what I would say is that anybody that looks at that, and looks at not just the price movement, but the positioning, the reasoning, the valuations, there's so much cognitive dissonance. So, okay, so let's go through this. So the argument is that something like an Nvidia is going to keep on, doubling and tripling because the demand for AI is unprecedented. And it's going to make everybody efficient, and all these chips are needed to implement all these Chat GPT type of protocols. Okay, fine, great. If AI is a game changer, which by the way I don't disagree with, I also know that it's been around for a while, right? I mean, this is just the large language models are accessible, but the reality is, the statistics that go into artificial intelligence have been around, since the days of the chess player, I'm not forgetting his name, who played against IBM in the 90s. Right?
Was it Kasparov?
Kasparov, right? We interviewed also on Thursdays, right? So it's like, he is the first one to say, "Listen, that was AI, right back then." So the point is like this is not new, but if AI is really going to be that much of a game changer and going to result in all these efficiencies for companies, the market should be discounting that in terms of the companies using the AI itself at some point, which would be the 493 other stocks in the S&P, which are just kind of blah in terms of performance this year. So you got people saying AI is going to take over the world and make every single company more efficient. And yet the prices of these other companies are not responding on the idea that they'll be more efficient, so bid them up now. You've got people saying that AI is going to result in less labor, yet everyone's worried about less need for labor, and yet everyone's still worried and talk about labor shortage. You've got people saying that AI is going to cause interest rates to fall because it's disinflationary, yet rates keep rising. So, I go back to, I think you're similar to me in the sense that you come from a natural skeptical, cynical place, right? I rant against narratives. It's not that I rant against stocks or crypto or whatever it would be. I rant against the reasons for why people argue to buy something. And I look at what's going on with this AI narrative, and I say to myself, just logically, it doesn't make sense against the price action of everything else that would benefit from AI. Now, Nvidia and other companies, again, I could care less about them from the standpoint that I don't own them, my funds don't own them. It's irrelevant to what I do in my research. But what you're telling me that with a PE as high as it is, that's going to be a fantastic buy and hold type of position for the next 10 years? Maybe it is, but I'm doubtful. I mean, yeah, everyone uses that Cisco analogy, right? That you've probably seen. It's like, Cisco had a similar PE and the company kept on growing, right? All the reasons for why the company would do well, were valid, but the stock did nothing for a long time.
I would also say the internet was successful eventually, but most of the companies initially in the tech bubble failed.
Right. And it's not, like I get it. It's like, okay, Nvidia, has real numbers. The earnings did blow out. Okay, but what drives stock price is not chat GPT, it's people. Right. And as long as people are emotional and overconfident and using leverage and using zero DT options and doing commission-free trading, like the company narrative is irrelevant. It's ultimately about what the crowd wants to fool itself into believing. Right. And that's sort of where I come from when I say Nvidia is in trouble. Don't short it, because shorting doesn't work on average, no matter what the position is. It's just like, we are in a mania phase. And as I keep saying, you can make a lot of money in manias. The question is, can you keep it?
Now, I know you've studied financial history and you've looked for risk on and risk off opportunities. And I think from the narrative and the social media posts, the sentiment, it appears that we're back on risk on for a lot of people. Have you ever seen a U.S. stock market bull market with an inverted yield curve before?
Yeah, of course not. I'm laughing because it's like it goes back to these narratives are so bizarre. And first of all, we should define what a bull market is. Right? And I could keep going back to a bull market's not some arbitrary percentage. It's like people say, oh, you entered a new bull market because we're up 20% off the lows. No. If it was a new bull market, it was at the lows. It's not after the move already happened. You've been in a new bull market if it's a true new bull market, right? But to your point, you don't tend to have bull markets in inverted yield curve types of kind of environments. You also, it's hard to see how you've started a new cycle in the absence of some kind of an event, right? So, which is I've used that line before that I think that we're probably going to have a credit event in the context of the pre-election year melt-up environment because you've got trillions of dollars that are due to roll over the next year, or the year after that, from low rates post-COVID. A lot of zombie companies are likely not going to survive, and the market probably starts to discount that at some point this year. But you look at the history of bear markets. Bear markets typically end with a bang, with an event, with capitulation. You didn't really have that, right? You didn't have that super spike in the VIX, which is typically what marks the sort of real fear low. I still think that's coming. Now, that's to your point about not being a perma bear. That's not about being a perma bear. That's about history, right? And to be clear, none of this has anything to do with like my own funds, which are rules based, which run the exact same way whether I'm dead or alive because they're based on quantitative signals. My bias, as I always say, everyone has a bias, right? My bias when I frame research in the way that I put content out there, my bias is not to be a perma bull, not to be a perma bear, but to want to see volatility, want to see flight to safety, want to see risk, because healthy markets are markets where there are big swings. And markets like this are wildly unhealthy because it creates everybody crowding into just a select number of stocks, what looks like a very smooth bull market, ultimately overconfidence, which is what I think we're seeing sentiment-wise now, which then leads to leverage, which then leads to crashes. If you have volatility in a system, you tend to not have the leverage because people get afraid of using leverage. It's in smooth, calm markets that leverage builds, and that's where it gets to be really scary because at some point the tail event manifests, and then there's a global margin call.
And the global margin call would probably be a big spike in the dollar index. So if the dollar, and we're recording this interview on Wednesday, June 21st, 2023, the dollar index right now is around 102. So if we get a big spike of the dollar index up to above 110, 112, 114, maybe even higher, that would cause a global margin call, like you said, because there's so much dollar denominated debt out there. If we did have a real bull market, Michael, I think credit would be expanding. But when we look at the banking system, the U.S. consumer, the credit card debt, the higher interest payments on the credit card debt, the U.S. federal government, these zombie companies, like you said, all these things, when I look at that, the health of the banking system, especially the regional banks, commercial real estate, red flags every single day, I don't see credit expanding. So if we were going to see debt expanding, credit expanding, that would be a signal that we have a new bull market because credit was going to increase in the real economy. And then that was going to affect asset prices and maybe valuations and higher multiples. The other thing is here, I think we've had another kind of mini, maybe it's an aftershock dollar milkshake, where a lot of these other central banks relative to the Fed have not been as aggressive at hiking rates, and some of them have even juiced more liquidity, and that liquidity has ended up back here in U.S. stocks, I think.
Yeah, and liquidity is interesting. So, I mean, this I think relates to why I think the Fed is trying to basically tell the market they're still not done raising rates, even though the speed would be slower. So you're right. On the one hand, there's data, which goes back to the kind of bifurcated, confusing environment. You've got credit contraction taking place. You've got some metrics actually saying quite the opposite. And you've got the Fed basically now trying to figure out what to do given the fastest rate hike cycle in history. I do think there's this really interesting dynamic here where, like, if you look at inflation in China, their economy reacted very differently post reopening than ours did. So inflation, you're actually closer to outright deflation in China than inflation, which would suggest that the PBOC probably has to start stimulating, and the government might start having to do some fiscal stimulus as well, which could happen in the second half of the year. Now, if that happens, now the Fed's got a whole another dynamic to deal with, which is they've raised rates, and now China may actually need to aggressively print their own currencies to counter their own weakness economically. And that naturally will seep into the Western economies as well. So I I hear you, and I don't disagree that there's liquidity that's come out, but I do think there is a real risk that there could be a sudden new wave of liquidity, which the Fed's going to have to somehow mop up because of China as opposed to what's going on here in the States.
Do you think that the other stocks, the other 493, are suffering from the lag effect of these accumulated interest rate hikes at such a rapid pace by the Federal Reserve Bank?
Yeah, and I keep going back to like the regional bank dynamic didn't happen because of interest rate hikes this year. It happened because of interest rate hikes last year, right? Which goes back to the thing which is absolutely wild to me. People don't really understand the point that there are lags with this stuff. That saying it takes 21 days to break a habit or to make a new habit, right? When it comes to spending patterns, it's a lot longer than that to change mindsets, right? It's not like the moment your credit card interest rate goes from 20% to 25%, you immediately start cutting back on what you're spending. It takes time, right, to change that behavior. So, and that's why I keep going back to, I think these narratives around new bull market just don't make sense to me, aside from the
look at mortgages. I mean, mortgages.
Right, look at mortgages, look at new interest rate, new credit cards. You probably saw the stat, right? New credit cards average rate is like 25%. Revolving interest rates are in the US, and people are very leveraged. Savings rates are very low. So it doesn't hit all at once, right? But at some point, people start saying, wow, I really am. I didn't realize how much my cash flow was getting hit from the way that I used to spend before. So now I actually have to take some actions. And who knows when that realization happens on average to the majority of people. But to think that you're in a new bull market when you still have that, holy shit, I didn't realize how bad this actually was. When you don't have that moment yet, to me, it's, I think, just misguided.
So the VIX is close to record lows. We've seen kind of this narrative play out in past cycles, especially the last Fed rate hiking cycle in 2017, 2018. The VIX started going low for a few months, I think around these levels, 13-ish, stayed low. It was kind of like an earthquake around the coastline. There was an earthquake around the coastline. The ocean water left the beach and headed towards the ocean, and then the tsunami came during the 2019 repo crisis. Do you think a similar type of volatility event could play out with credit and with the VIX?
Yeah, so maybe. So, okay, so a couple things. First of all, the historically, the average level of the VIX is like around 19. So, and it's not like the one when you go below that average is when you are destined to have a VIX spike, right? So you can have low volatility last for a while. And again, I keep going back to, we are in a pre-election year. Pre-election years tend to be good environments and tend to be the best of the 4-year cycle, but it can be volatile, just like 87 was, right? Which was also a pre-election year. Now, people say the Fed, will keep hiking rates until something breaks. They define the something breaks wrong. They think it's the S&P going down, and they think it's the VIX spiking that is the something breaking where the Fed steps in. I think they aren't fully understanding the concept of what that really means, something breaks. When the VIX spikes from very low levels, that tends to occur as credit spreads are blowing out, meaning the differential between high yield junk and high quality AAA. So when the differential in yield widens, that suggests that bond investors are saying, you know what, I need to get compensated more. I need more yield because there's a risk that this highly levered junk company might go bust, right? It's default risk rising, and default risk is directly correlated to volatility, which is why the whole flight to safety dynamic kicks in to begin with, largely in long duration treasuries, except in a year like last year. Again, the hell that I went through. Now, if you believe, as I do, that these zombie companies, that these highly levered players who were so used to low rates, were operating on such small margins, now have to roll over that debt into higher rates and may not survive the interest expense differential as a result, you almost have to have a VIX spike because that means credit spreads are due to widen. That means default risk has to be repriced. So I'm trying to go to the question from the standpoint of the relationship of VIX to the bond market. A low VIX is inherently not bad, but it can be bad if there's in the background the looming realization that the market has priced in the risk of defaults incorrectly in the bond market, which I think is probably the case, and which goes back to why I don't think the bear market is over, because typically when bear markets are over is when credit spreads have already blown out, which again, you haven't had just yet.
Do you think the MOVE index, which is the bond volatility index, is more accurate than the VIX then?
It's an interesting question. I mean, I had his name escaped me off the top of my head. The guy who basically came up with the MOVE index on a Twitter space probably a year or so ago. I think there's probably some truth to that, but I don't think that's. I would rather look at sort of just pure option adjusted credit spread differential as opposed to just the MOVE index. The MOVE has been moving, pun intended. Kind of the derivative of the derivative, right? The volatility of vol has been quite high on that. I don't know if it's necessarily more predictive of the VIX. I don't actually, by the way, think the VIX is predictive, except at the extremes. The extreme, by the way, would be, from my own research, not 14 on the VIX level. The extreme would be closer to 12. And that's typically when you have the real complacency. And then the extreme on the other end would be around a VIX level of 33. So usually if you have a VIX level of 33, that tends to mark a short-term low, and that tends to be a period where you actually want as much high beta sector exposure as possible. Usually when you're in a VIX level of like 12, you actually want low beta defense because you're vulnerable to a VIX spike and decline in stocks. So you might as well be defensive in advance. So you're close to it, right, with where we are now. But I keep going back to, I could be totally wrong, and I go back to I can't predict the future better than anybody else. But I look at the as I would say, the conditions that they're in, and it just I don't see how the VIX can stay at this level when there's a real risk of some of the market saying, "Holy shit, we never thought that these companies would have to roll over their debt into these higher rates. We always thought the Fed would have to cut before that."
Do you think that the Fed is close to breaking the U.S. banking system with the inverted yield curve, the rapid pace of the rate hikes? I mean, some of these regional banks have no net interest margins because of the rate hike. So, and then I see all the problems with commercial real estate, but very little bank failures. It reminds me very similar to the residential real estate in all the news headlines 2005, 2006, 2007, where we haven't started to see this domino effect of all the banks failing yet, but we're starting to see all the bad news pile up day after day after day.
Yeah, although I'll tell you something, it's interesting. I floated that idea out before, but it's like how do you solve the hole? How do you fill the hole from the regional bank side of things? You fill it with the return to flight to safety trade, where stocks go down, volatility increases, credit spreads widen, and treasuries, which is what these regional banks and old banks pretty much hold for the collateral, right? The safe collateral, that rebounds in price and drops in yield on the long end, meaning things get even more inverted, right? In that kind of, oddly enough, in that kind of juncture, depending on the duration that's being held. So, yes, I agree with you. The Fed is pushing the banking system closer to insolvency, but that becomes almost self-correcting, right? Because the closer you get to insolvency, the more likely you are to have a traditional risk-off sequence, which would benefit the banks because of other money for a moment in time going to treasuries because nobody would want to hold stocks during that juncture. So yeah, I think it's a complicated dynamic.
I don't think it would benefit. Sorry to interrupt you. I don't think it would benefit all the banks though, because I mean the regional banks have a much higher percentage of their loan books exposed to small business loans that are having problems in commercial real estate than some of the larger banks.
Yeah, I think you're right, and there's a nuance, in that point. So it's kind of like, would the convexity of treasuries in a flight to safety trade be enough to counter the fundamental deterioration beneath the surface? And that's where real stock pickers and true bank analysts hopefully add value. Not something that to me would be anything I could add too much thought on, but I just think there is a scenario where if you engineer a in quotes short squeeze in treasuries, which by the way is not that impossible. See, I saw people like poking fun at the idea, how could you have a short squeeze in treasuries? Okay, if you look at large speculators in the futures market, you've gotten so many large speculators betting on rising rates that they're due to get their asses handed to them. Like this is what happened. This is just it's using Jason Shapiro's kind of crowded market type of mentality. The truth is like there is the potential for a rip higher in price in long duration treasuries, which I think would coincide with a risk off correction in stocks at some point this year. And all I'm saying is that would be enough of a tailwind to at least for a moment in time fill enough of the hole while the fundamentals for everything else still look really, really poor.
So the Treasury General Account is supposed to start refilling this week. Do you expect this to be a net liquidity drain on asset prices like stocks then? And that'll be, I guess, a headwind then. So more bearish potentially as liquidity is drained, as US Treasury refills?
Yeah, maybe. I think the market is starting to sniff that out. And I say that, yeah, listen, I said I think mid-June is probably where you might have another risk-off type of juncture because of the capitulation in defensive sectors, right? And it's, again, I'm not trying to be perma bearish. I said, I think we would start a correction starting the third week of April, which didn't happen in large cap averages, but a lot of things were weak, and then everything flipped to risk on post debt ceiling. But I do think that we probably are entering, if not already, in a risk off environment, which doesn't mean that you short stocks. It just means we're going to be in a volatile period. And on that point about the TGA, that might explain why you're starting to see some bottoming movement in defensive sectors of the stock market, right? So if you look at utilities, you look at consumer staples, you look at healthcare, they all crapped out towards the end of May, which is consistent with a risk on cycle. June, has been incredibly strong, certainly relative to history. But now they're starting to firm up again as this TGA dynamic is playing out. So I do think that there seems to be some money at the margin that's positioning defensively on the idea that liquidity is going to get sucked out further, which is why they're going into lower beta, high dividend, higher dividend type of sectors. Again, utility, staple, healthcare. How long that lasts, I don't know. The thing is, all these dynamics and all the overconfidence is happening in a seasonally weak period for equities anyway. Right? It's like May to October, the so-called sell May go away dynamic. Tends to be lackluster for stocks. I put that data point before. You look at the average performance of the S&P 500 in pre-election years from May to October. The total period average is 3.2%. Okay, you blew past that already in June. You look at small caps and their performance from May to October in pre-election years, Russell 2000. Average return is 1.5%. Way, at least for a moment in time, blew past that. Last week, came back a decent amount since then. But my point in saying all this is that the coinciding of the TGA, what looks like some firming up of relative strength in defensive sectors and seasonality, not to say that you are guaranteed by any means to go down hard, but the conditions just don't favor the bulls, just as everybody is getting hyped up about the new bull market.
Yeah, it seems we've had a bear market rally, but the fundamentals of the real economy, a lot of these companies reporting earnings. I mean, Walmart's talking about how they have more affluent customers that have traded down and are, instead of shopping at Whole Foods, buying their groceries there or buying other stuff at higher price, big ticket places, they're trading down. So it seems like the consumer is just not going to be spending at those clips. In terms of seasonality, Michael, haven't the most stock market crashes occurred after Labor Day? So September and October, when a lot of financial professionals get back to their desks.
Yeah, it could end up playing out like 2011 still, which is ironic because everyone was saying, you had the summer crash in 2011 because of the debt ceiling, debt downgrade, but that dynamic could still play out. Yeah, I think there's some element of truth to that. I don't know. I don't, there's that saying, right? Nothing matters until it matters, and then when it matters, it's the only thing that matters. It could be because of dynamics like you're saying around low liquidity and traders taking off during the summer periods, all this stuff, or it could just be for whatever reason the market starts to care about higher mortgage rates, the market starts to care about defensive sector positioning, the market starts to care about small caps, the market starts to care about retailers. Who knows what the spark is ultimately that will cause a decline? But again, it's like the tinder is dry here, right? To light it up.
So you don't see a lot of bullish tailwinds then right now in the real economy or any specific companies or sectors?
Well, look, I think if you're going to be contrarian, you probably want to bet on energy and commodities, right? And I say contrarian purposely because it's like you entered this year and people really were not. Really, we're very optimistic on drift in energy, and then technology took the throne again, right, as the leader. I think probably that becomes an interesting play to work off of emerging markets. Again, if China starts to stimulate, I think that makes sense. And then if I'm right, and it sounds like if you're right as well on this idea that all along this actually was a bear market rally, that we still are in a bear market, then I actually think gold becomes really interesting. And I say that from the standpoint that gold is really not correlated to very much. So from my vantage point, gold momentum needs to have institutional money believing that you're in a prolonged bear market, believing that you're not in a bull market. And I say that because if institutional big money believes you are still in a bear market that could last a while, they want more diversifiers. And the truth is, most things are variations of beta. There aren't that many true non-correlated assets that institutional money can allocate to. So the impetus ultimately has to be around a bear market for equities to cause, at the margin, some reallocation of gold, which I think is happening and might be the reason for a breakout, and to have momentum then kind of feed on itself. So, yeah, those would be the real plays. Now, on the dollar, since you mentioned a little bit earlier, I had put out that tweet like a month ago saying, the dollar's about to make the greatest comeback since Lazarus, right? And the dollar started, running, not in a huge way. If you do have a risk-off period, yes, the dollar should benefit. Maybe it takes out the prior highs. But the only thing is, I do believe that beyond that, you probably are going to have a secular bear market for the dollar in general. And I say that largely because you've had a secular bull market because of QE3 back in 2012. You don't have quantitative easing. It's hard to imagine a situation barring some real deflationary event, the Fed restarting in an aggressive way, QE and expanding the balance sheet at the pace they were before. All that should be a dollar net negative, right? Which sounds weird. It's like, I thought money printing was supposed to make the dollar go lower. Oddly enough, money printing the last 10 years actually made the dollar go higher, right? Because it eliminated risk.
It depends on the euro dollar market and then dollar denominated debt. So every time the dollar got weak with the QE programs, these foreign governments and foreign central banks that would go in public and say, we're looking for an alternative system, alternative currency, or the petro yuan or something like that. Like, that's what they said in public. But what they actually did was they borrow more dollar denominated debt every time the dollar got weak. So what they said in public and what they actually did were two very different things.
Correct. You're spot on. And that's why these things this goes back to why I'm cynical on narratives. Right, it's like, do what people are doing, not what people are saying they're doing.
So I agree with you with gold demand. So I track demand extensively, and really the only demand drivers right now are non-G7 central banks that are moving their reserve assets, so their trade surpluses, away from US Treasuries. But those are like because of what they saw with foreign policy decisions, the penalties on Russian government. So the non-G7 central banks are large net buyers of gold. And then there's large private sector demand for gold in like China, India, Turkey, many of those countries. So the institutional demand just is not there. The cost of capital for a lot of these gold producers, unless you're a really low cost one, is sky high right now. So in terms of contrarian plays, I 100% agree with you on energy. I think there's bargains across the board, whether it's a Petrobras in Brazil with their dividend yield and their amazing oil wells, or Suncor in Canada, tons of good US and Canadian ones too for valuation and cash flows. Yeah, and it's look, we're either going to live and die based on AI stocks, or you're going to thrive based on everything else, which would benefit from AI, right? And that, by the way, would include, miners. I mean, it's like I did a Twitter space with somebody talking about how AI can change the game when it comes to, things that are in the ground and what's being actually mined out, and even on the driller side, it's like, again, it should affect all industries if it's really as hyped up, if the hype is as real as people make it out to be. So, but the problem I see with artificial intelligence is then the economy would take many years to adjust. And so the economy right now is built on consumer spending. But then if these companies, if the corporations are able to make more profits with artificial intelligence software and those programs instead of human beings, that means a lot of human beings lose their jobs, and a lot of human beings don't have income to consume and don't have savings to consume.
I totally, which is why, the end result, is a different discussion. But, the end result to all this is probably going to be universal basic income. I mean, the effect of AI. No, really, the effect of AI. Are we going to talk about social credit scores and then central bank digital currencies then? Because those things, it seems like the Davos people want all three of those together. Yeah, well, and it's like, you probably saw that headline. I joke about that. I use that line throughout the whole, Twitter run-up, Bitcoin and crypto run-up in general. This idea that when an investment becomes a religion, it's time to lose faith. And there was a literal church service. I think it was held in Germany, that was using ChatGPT for the church service. So, like, we're all going to be basically ChatGPT's bitch. I mean, that's what's going to be happening with this kind of environment. And doing that means we're inherently moving towards a more socialist system. Because what's the incentive of doing anything if all you can do is just type it into some bot? You don't even know if it's real, but you accept that it's real.
The way the economy is currently designed with GDP and inflation data, jobs report, those things are not going to make any sense then if artificial intelligence is going to cause a mass, the economy is going to have to adjust and many millions of people are going to lose their jobs and have to be retrained.
Yeah, but I'll tell you something, the retraining argument doesn't make sense to me because so you retrain people, but by the time you retrain them, people learn in a linear, slow way. Technology is inherently exponential. So by the time you retrain somebody to a new profession, ChatGPT is already many orders of magnitude in that new profession. So I don't know. I question the narratives around all this. I'm not convinced that AI is going to take over the world the way that everyone seems to make it out to say. I mean, I thought at this point, in 2023, we'd have totally autonomous self-driving cars. It's like we don't. I thought at this point we'd have flying cars from the Jetsons. We don't. So again, I go back to narratives. Follow price. The extreme. Sure, there's all kinds of nasty, things you can go down the rabbit hole on what all this means for the economy, for people, for capitalism, socialism. I'm just not convinced it's going to happen in our lifetime. Maybe I'm wrong.
Well, even if right now, I think the only product is ChatGPT. So, I mean, all this is on potential. It's not on sales. It's not on profit margins or free cash flow yet. So it's all potential. It's hype. It's very similar to the tech bubble, how those shares, the valuations on those shares were just driven up on clicks. So setting up a website and clicks. And the majority of companies failed because they couldn't figure out a business model for the internet at first. Now, obviously, here we are, 20 years later after the tech bubble crashed. And there's plenty of companies that have figured out a business model, but like the first movers, almost all of them went bankrupt.
Yeah, no, that's exactly right. So it's again, be careful of narratives, be careful of going where the crowd is going. I keep going back to that point. It's like the crowd is right on average, just never right at the extremes. Now, I happen to think that we are at an extreme in mentality.
So do you think then that people, for defensive or liquidity purposes, they should have a higher percentage of cash in US dollars? They should have more liquid things like maybe gold or Bitcoin in case the stock market does crash, and they can go and buy quality shares, say like a Google or some of these other companies that the valuation right now is too high, but they have cash on the sidelines waiting to go buy something that when it's a lot cheaper.
Yeah, I mean, I wouldn't do from the standpoint of like an investor should be doing this or should be doing that from a waiting perspective, but I just think that every single person should be having a real self-evaluation around how much concentration risk are they actually having in their portfolios, right? So it's like, I have to laugh a little bit when I see people talking about, investing in home builders while they own a very expensive home. Like, that's not a hedge. Right, that's not that you're actually taking on more concentration risk under that scenario. So that's a personal, reflection that I think every investor has to make. But broadly speaking, does the idea of having things which move differently to public markets, should those be in general not only a portion but maybe a larger portion than you might otherwise consider in a new bull market? The answer is probably yes. What that percentage is, I have no idea. It depends on everybody's circumstances.
Yeah, I think a lot of people are not as diversified as they think. Some people don't even care about diversification. I mean, there's a lot of fear of missing out or FOMO and people trying to get rich quick. I mean, people were buying stock options in NVIDIA, paying higher and higher prices. 70% of stock options expire worthless. I know a lot of young adults, they're not diversified at all. I mean, they gamble on Bitcoin and crypto. They put most of their savings into that. Every time it drops, they buy more, hoping that Bitcoin's going to hundreds of thousands or $1 million. So they don't believe in the diversification narrative.
Yeah, listen, everybody wants to get rich quick until they start realizing that's the fastest way to get bankrupt, right? I mean,
the Fed has we have to blame the Fed for the last 15
no, 100%,
years, right?
No question.
Because the zero interest rate policy, right? So people couldn't get an easy 5 or 10% on 5% on US Treasuries or dividend yields of some of these stocks because they were doing share buybacks or other relatively safer yield for retirees.
Right. No disagreements. The core of this, and I know it's popular to bash the Fed, but the core of this is, I take it a step further. It goes back to really the Iraq War and just the idea that we'll go to war and you guys just go out and spend. We, the government, got it. Don't worry about it. Right? There's so much that actually has seeped into culture from the way that monetary policy has been set and the way that fiscal policy has been managed. Right, and the message from the government to us as citizens that it goes back to those are the conditions that result in everybody basically just being a short-term YOLO, get rich quick type of trader that we see today, which ultimately ends up making more people lose money than make money.
Yeah, I agree. I'm just seeing the posts on social media and stuff like that. I released a really good balanced interview yesterday, not bullish, not bearish, just going through data, talking about charts or valuations or things like that. And then I'm just called a perma bear or something like that I missed out on the bull market move the last couple of months. This is kind of ridiculous. Normally, like in terms of sentiment, I mean, we're heading towards tops if lots of people are going to keep posting stuff like that.
Yeah, no, and that's I've used that line before. It's like, you're right when the counter argument is an insult. I mean, I'm seeing a lot of that. And listen, I mean, again, my funds have been risk on, in this month in particular, but it's getting to be kind of silly. I mean, the time to be bullish is when everybody is bearish. And the sentiment that I got, at the October lows, when I was saying the end of the world's at hand, that's why a stock market melt-up's about to take place. And I was very aggressive on Twitter saying melt up, lead lag report, melt up. I kept on using that term nonstop. And it's like people forgot about that. And I was getting the vitriolic hate that I was getting back then is now back, but this time from the bulls. And I was the one saying that this is the environment for a melt up. It's like everyone.
Well, on your financial Twitter, though, I mean, you are very sarcastic, though, and a lot of people are jealous how many Twitter followers you have. So, I mean, like, I
don't care about the followers, dude. It's like this is what's silly about all this stuff that people like look at this. Oh, they say, oh, you make more money on your research than your funds. It's like these fucking people, all due respect, pardon my language, they don't know what they're talking about as far as the business of what I do. Listen, there are a lot of people that are very smart on FinTwit. There are a lot of people who have large followings who come across very smart, but in reality are not. And there's a lot of people that fall for the gurus of the moment where they are not those gurus taking the risk of actually being an entrepreneur and bringing a strategy out in the world and seeing if it works or not. Now, people can hate on me all they want. Okay, the funds and the strategies that I run, which are very serious endeavors, which are very costly to keep open, which I deeply believe in, they are designed for a very particular cycles where you have risk on and risk off both, and cycles where it's not just about large caps. So my kryptonite from day one has always been an environment of pure risk on, pure large caps. You get a lot of people that then will attack saying that I don't know what I'm talking about because look at the results of the funds, not realizing, as I keep saying, there's no gurus, only cycles. And then the people that they follow wouldn't have the guts to take the steps that I've taken to be an entrepreneur, to put something out in the world, to believe in it, and to subsidize it. So what I say to all those people that end up trolling and all this stuff, it's like, dude, God bless. I mean, you can be the obese person in the stands criticizing the gladiator fighting, that you're watching as that person's marred in sweat, the man in the arena analogy from Roosevelt, or you can at least be respectful and accept that those that are actually trying to make it in this business beyond just some trade or some narrative, at least give them credit for doing what a lot of people don't, which is taking the real risk, which is being a business owner, not a portfolio manager of a personal account.
It's very difficult setting up an exchange traded fund. The average person doesn't realize this. My friend Andrew Chanin set up the cybersecurity ETF hack.
Yep.
So he had to live way below his means, his costs, his fees. The ETF became successful, and then he was sued a bunch of times. So, I mean, it's just by larger corporations saying, oh, we had a patent on this obscure thing that had really nothing to do with cybersecurity, but we're going to sue you, and we're going to try to get you to sell out the ETF to us for pennies on the dollar, and then we'll drop the lawsuit.
It's a very hard business, and it's one of those things where it's more a side note, but it's just fascinating to think through, I think, because I've gone through this. Some people, when they see a fund that's not done well, knowing that it's very expensive to keep a fund open, they say, well, why keep the fund open? Performance sucks, just close it, and call it a day. Okay, well, here's the thing. If we agree nobody can tell the future, as a business owner, somebody who has a fund out there, it becomes this really interesting intellectual question. Do you close a strategy which has not worked when you launched it? In which case you're closing it because it's you don't want to fall for sunk cost fallacy, right? Because you put all the time, effort, and money into it, and it's just not working. So stop throwing good money after bad. Are you closing it because of sunk cost fallacy, or are you selling the low by closing that strategy, which so happened to not work the moment you launched it? And the true answer is you don't know except with hindsight, right? But like for all the people that critique, think about being in the shoes of the entrepreneur, the business owner. When you're in that kind of environment, when you have something which is languishing, is not doing well, you've got to come across confidently. You've got to keep on pushing and pushing, and you got to wait for the cycle to come your way while everybody else is in the stands being overweight, pointing at the gladiator in the arena who's fit and fighting for his life, right? And it's like, it's just silly. You don't grow by attacking others. You grow by collaborating and by respecting, right? And that's why I just don't take shit anymore from Twitter. It's like, you want to come after me? I'll be the most relentless blocker, not because I'm disagreeing with you. It's because I don't need to hear your criticisms when you provide no counter that's valid, and you don't know my anxieties and my struggles as an entrepreneur.
Yeah, I agree. And most of those accounts are burner accounts that have over half a dozen.
Yes.
So it's like Greg or Chris or Matt, and then a bunch of numbers after it, and they have all these burner accounts now. So they just troll and flame people, and they and then when one account gets blocked, they just go to the next one.
Yeah, and I don't understand. I mean, I guess there's some weird psychological dynamic that happens there, but it's like, do you not have better things to do with your time? Like, leave me alone. Like, time will prove if my belief in my approach and my strategies in the cycle dynamic is right. Like, just be productive and do other things. Go out and live life. Stop trying to attack others that are trying to live theirs.
I agree. And I applaud you for trying. I mean, I don't know how much you're paying in compliance fees and regulatory fees, but it has to be, is it similar to a hedge fund with the 7-figure fees for compliance and regulatory and insurance and all those things?
I don't talk about the funds on Twitter because that has to go through compliance. Like, the moment I do any kind of content related to the funds, that's got to, and that I'm extremely regimented and disciplined when it comes to that point. The lead lag report, all the lead lag report handles that you see on Twitter, Instagram, YouTube, it's a separate publishing company. So this is what I say, like, on social media, people don't understand that me as a publisher of research is different than me as a portfolio manager of funds, which are rules-based, that I'm basically an investor of, having created the strategies. So, I am very careful with that. What I will say is that I'm purposely loud on Twitter because it gets engagement. And it's kind of like, who do you blame, right? Do you blame the person that's screaming or the person that's giving the microphone? Right? And it's like, Twitter's giving the microphone through the algorithm to amplify that loudness. So, I'm gonna use it because that's the only way I can counter a cycle that has been brutal with treasuries last year and with this large cap dominance this year. I'm confident that the cycle is going to favor what I'm doing. I have no idea when, but I know that I'm stubborn enough to see it through.
Well, I think from our discussion today with financial history, the Fed has just created more record distortions because here we have a severely inverted yield curve. If the Fed raises interest rates, it'll make the yield curve worse. Problems with the banking system, commercial real estate, and here we have stocks in a bull market, probably because of kind of a mini dollar milkshake, because the Fed's been the most aggressive with the rate hikes.
Yeah, no, I think that's right, and that's why I keep going back to bear markets make fools of bulls and bears.
Well, I want to thank you so much for your time today, Michael. If my listeners want to check out the lead lag report, your ETFs, or follow you on Twitter, how do they do so?
Yeah, I mean, so it's leadlagreport.com, also on Substack, at leadlagreport on Instagram, YouTube, Facebook, Twitter, and then the funds are ATACX, RORO, and JOJO. Again, the performance has been lackluster because they all rely on treasuries to be the safe haven. The nice thing is that treasuries have sold off so much now that there's money to be made whenever risk off actually returns, which I'm hopeful is the case. And other than that, Jason, I appreciate you and your hard work. Keep killing it on YouTube and providing content like this to listeners.
Great. I think our listeners will get a lot out of this. And there's some interesting contrarian plays like oil, energy, US Treasuries. I mean, we were talking about uranium on your Twitter spaces, and we started to have some move in the uranium spot price. I think uranium's going to have a bull market if the government's actually allowed new nuclear power plants to be built.
Yeah, they will in time. It's not a matter of if.